What's the situation with inflation? What impact is it going to have on interest rates? What's the Fed looking at doing? How's the economy performing? How's the market? All the answers to these questions and more on this update from your market segment. Hi, I'm Silas Parker, Principal Financial Advisor at Silas Parker & Associates. We help you discover your happily ever after. To learn more about us and to schedule an Aspirations Session, visit silasparker.com. Today, we welcome back Regional Director at Russell Investments, Roman Samuels. Roman, welcome back. Good to be with you.
Silas, what's up, buddy?
Let's dive in. Our clients and investors have lots of questions about what's going on and impact on their portfolios, things they should be considering to navigate these times that we find ourselves in. So please take it away.
Yeah, wow. A lot of nice, easy questions you left for me. Let's just solve the mysteries to the universe here while we're at it. No, hi, folks. Good to be back. Good to be back with you, Silas. So let's dive in. We have basically compiled our second quarter results here at Russell Investments. And so what I'm going to share with you is some of our research that we've gathered over the last quarter, what's happening in the economy, what's happening in the markets. And our objective will be to hopefully give you a little bit more confidence, a little less doubt, less concern about what's going on in the markets and what are some principles that you can use to be a great investor during this time frame. So we'll kick things off, and I always like to focus on this chart here from our research, which focuses on the first 6 months of this year. We're halfway through the year at the time of this recording. It's always nice to just take a pause and just ask, where have we been so far this year? What's happened? So on this chart, you're seeing 3 lines. First line in blue is showing us US stocks. There's a gray line that's showing us a 60-40 portfolio, and then an orange line, which is US bonds. And a 60-40 portfolio meaning 60% stocks, 40% bonds. So basically a combination of the orange line and the blue line. If we had put $100 into each of these 3 lines at the beginning of the year, today we're at 104, 105, 106, respectively, across each of those lines. So everything's positive year to date. That's great news. However, you're going to see a very large dip there in the middle. It wasn't a smooth ride up. It was sort of a chaotic ride up. And if anybody's wondering, well, gee, I wonder what that is your tariff timeline right there, which we're going to talk about a little bit more as we move through here. I think there are 3 takeaways for investors looking at this chart. The first takeaway is we hear this all the time. And Silas, I'm sure you hear this from clients where they say, Silas, I just want to wait until the market drops and then let's put our money into the market. I'm sure you've never heard that before, right?
Never heard it. Never. Nobody ever tries to time the market.
Nobody, right? Nobody. So we hear this all the time. The clients are saying to us, I just want to wait until the market drops. And then when the market drops, I'll put my money to work. Well, folks, you got a market drop in the first 6 months of this year. A pretty big one, actually. Did you put money to work during the tariff debacle? I doubt it. Why? Because during this time frame, if you had turned on the news and listened to anything, whether it was CNN, Fox, CNBC, MSNBC, Wall Street Journal, New York Times, what were they saying? Tariffs are going to lead to massive inflation, recession, the uncertainty is at an all-time high. We've never seen this before, blah, 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 blah. And who's going to feel the conviction to say, you know what? I'm going to put my money into the market right now. Very few investors get that conviction when everybody around them is screaming that this time it's different. And so I put this up here to say that if you're the type of client listening to this who has said to your advisor, or you've said to Silas, I'm just going to wait until the market drops and then I'll put my money to work, I challenge you to think about whether or not you did put your money to work during this market drop. And if the answer is you didn't, then maybe we're not as good at market timing as we think we are. And maybe the strategy is not to time the market, but to just dollar cost average our money in to the market and take the timing out of the equation. So that's the first takeaway, is just to show you that you got a market drop in the first 6 months of this year. And if you didn't pull the trigger, then maybe we need to rethink our strategy here. That's takeaway number one. Takeaway number two, look how fast the stocks recovered from the drop. I mean, we're not done with the tariff debacle here. We're still in the tariff negotiations and all this, but stocks don't care. They shot right out of it, almost a V-shaped recovery. And you'll see some of these incredible run-ups happened right after a sharp downturn. And this is the second takeaway. The best days in the market are usually neighbors with the worst days in the market. And so that makes market timing even harder to do, because it's not as if the market's going to drop and then stay down for the next 2 to 3 months. Usually the market drops are pretty quick, and then there's an immediate reversal. And if you're not in when that reversal is happening, you're missing some of the best days. And we're going to show you a little bit later on how much that might actually cost you, missing some of the best days in the market. So that's takeaway number two. Takeaway number three. This is why we own bonds in a portfolio. Look at that orange line that basically held the line during the drop of stocks. Look at that. I mean, bonds did exactly what they were supposed to do in a portfolio. They diversified against your stocks beautifully. And so for a lot of clients, it's been a rough road in bonds over the last couple of years. I get it. But when stocks misbehave, this is why we own bonds in a portfolio. So really powerful takeaways, I think, that we can learn about how markets have behaved over the last 6 months. Now, briefly shifting to capital markets. If we take a look at the last quarter over here, US stocks are up 11% on the quarter. International stocks are up 11.8% on the quarter, and emerging market stocks are up 12% on the quarter. So last quarter, international stocks and emerging market stocks beat the US stock market. Interesting. But I think the bigger story is in the 1 year. Over the last 12 months, US stocks have given you 15.3% return. Take a look at international, up 17.7%. Take a look at emerging markets, tied with the US at 15.3. So this is no longer a 3-month trend. This is no longer a 6-month trend. This is no longer a 9-month trend. This is a 12-month trend of international stocks beating US stocks. Why do I say this? Because this is why we own diversified portfolios. Because the US is not always going to be the winner in a portfolio. It has been, certainly over the last 3 years, certainly over the last 5 years, and certainly over the last 10 years. But it hasn't been over the last year. Is this a sign of things shifting in the market? Maybe. We're going to put a little bit more color on that a little bit later on. But folks, this is why folks like Silas, other investment professionals constantly reiterate the value of owning a globally diversified portfolio rather than putting all of your money into one stock market. Because sometimes that stock market isn't the best place to be. We're going to put more color on this a little bit later on. Let's take a look at the US, though. This has got to be my favorite chart that we come out with every quarter. This is our economic indicators dashboard, but I call it our economic health check. Imagine you go into the doctor's office. What's the first thing they do? They scan your vitals. And what are they looking for? They're looking to see, is everything in normal range? And anything that is out of normal range is where they tend to draw the commentary. So what we're looking at here is, imagine that the US market and economy has walked into the doctor's office and gotten a scan. Here's the readout. The blue shaded region is the normal range for each indicator, and the orange marker is where is it right now. And so what we want to see is as many of these orange markers hanging out in the blue shaded region as possible. And if you sort of scan down this, you actually see everything's sort of in normal range. Now, if we look at the yield spread, this is a little bit outside of the normal range. This is referring to the fact that the yield curve is still inverted, which is because of the Federal Reserve keeping interest rates high. We're going to touch on that in a second. And we see consumer sentiment is really low. You can see that the range goes to 50 and it's at 52 right now. Gee, this certainly couldn't be because 99.99% of the coverage of the current administration is negative. Couldn't possibly be related to that, right? When you have coverage, regardless of who's in charge, that is unbelievably negative, what's going to happen is consumers aren't going to feel that positive about the whole state of the world right now. So I think there's an interesting comment to make here, which I'll make in 1 second, but I want to draw quickly on inflation and unemployment. Inflation last quarter was 2.8%. At the close of this quarter, inflation was 2.3, dropped 50 basis points. Unemployment, 4.2% last quarter, 4.1% this quarter, dropping. So inflation is coming down and unemployment is coming down. Now that runs a little bit counter to the narrative that we've been hearing, which is saying that tariffs are going to cause runaway inflation. And I think what's causing this lower inflation are a number of forces. Number one, if we look at energy costs are dropping. They're actually declining in price. That's oil and gas, that's natural gas, things like that. When energy drops, I always say this to clients, oil touches every product or service in the economy, sometimes multiple times throughout the supply chain. So if the cost of oil is elevated, guess what? You've got structural inflation in your system. But if the cost of oil is dropping, you're actually really doing a lot to lower that inflation number. So I think the current administration's energy policy is helping lower that inflation number and maybe countering some of the tariff offsets. I think also it's worth noting that last month in June, we were economist expectations were that we were going to run at about a $50 billion deficit in the Treasury, causing us to borrow $50 billion from the Fed. But we actually posted a $30 billion surplus in the Treasury, causing us to borrow zero from the Fed. So if we're having to borrow less and less money from the Federal Reserve, that means we're having to print less currency. And when you're printing less currency, that's also helping to reduce the inflation pressures. Now, some have argued to me when I've been on calls with them that, yeah, but Roman, all the tariffs haven't hit yet. And that's true. The tariffs are all going to go into effect, we are told, on August 1st. So let's see if when the tariffs all go into effect, if inflation starts to reverse. But I think this is a really, really powerful, good piece of information. And this is good news. We want inflation to be dropping. That's what we want. And hopefully this continues. But I think this is powerful for all you clients out there. The comment that I would make here is just because you hear something repeated a million times does not necessarily mean it's true. What we do when we build portfolios is we follow the data. That's what we follow. We want to look at, is the data showing us that the economy is improving? As of the close of last quarter, the data is showing us that the economy is improving. That's great news. And what we think is that's probably going to lead to interest rates getting cut sooner rather than later. I don't know when, couldn't tell you, but I think this is why you're hearing the president put more pressure on the Fed to say we need to cut interest rates, because they're looking at data like this that's saying that the economic indicators are improving. The Fed is saying it's too early to tell. So we're kind of in this sort of tension dynamic, if you will, of the Fed saying we got to wait and the current administration saying we don't need to wait. So that's sort of the dance that's going on right now. Meanwhile, consumer sentiment is really, really low right now. Consumers don't feel very strong about things. I think tariffs have a big role to play in that. They're sort of hoarding cash, if you will, waiting to see if prices go up. But what we have seen, and we've run charts like this in the past that show that whenever consumer sentiment is low, future returns in the market are really, really high. And that's because time and time again, because expectations are low. It's almost like, how much lower could they go, right? So when consumer sentiment's low, I think that actually bodes well for future returns in the market. So a quick snapshot of where we are right now in the economy. Now let's briefly put a kind of a feather here in this idea of where the markets are year to date. So we talked about last quarter, but what about year to date, first 6 months of this year? We'll take a look at US large cap, up 6.1%. Not bad. Take a look at non-US, take a look at international stocks, up 19% year to date. Take a look at emerging markets, up 15.3% year to date. Take a look at a balanced portfolio, which is 60% stocks, 40% bonds, up 7.4%, beating US large cap. This is powerful. This is really powerful because it shows us the value of a diversified approach. Over the last few years, it's all been about US large cap, US large cap, US large cap. Well, in the first 6 months of this year, it hasn't been all about US large cap. It's been about a lot of other things. And if you're a diversified investor, you've benefited from being in that type of portfolio. For all of you investors out there who are doing it yourself and who keep saying, you know what, I just believe in the US only, and I'm just believing my Magnificent Seven stocks, well, I got some information for you a little bit later on that maybe might have you thinking a little bit differently. In the first 6 months of this year, a diversified approach won, not a US only approach. Now, I talked about at the beginning of this call how missing some of the best days could really hurt you. So let's actually put some numbers behind that. Let's go back 25 years to January of 2000. And let's put $10,000 into the S&P 500 index. Now let's imagine we put our $10,000 into the S&P 25 years ago and we missed 0 days in the market. In other words, we were invested all days over the last 25 years. Our $10,000 would have grown to $67,000. Not bad. Not bad. Now let's assume that we missed the best trading day of the market over the last 25 years. So we were still invested all other days in the 25 years, but we just so happened to miss the best day. What day was that? It was October 13th, 2008. And during that day, the market gave you an 11.6% return. If you had missed this day, instead of 67,000, you would only be at 60,000. $7,000 lower on an initial $10,000 investment by missing one day in 25 years. Now, what if we missed the two best days in 25 years? Well, what was that second day? October 28th, 2008. Same month. Same month. Market was up 10.9% during that day. Gee, I wonder if there was anything happening of significance during October of 2008. I don't know. I feel like something vaguely might have been going on at that time, but
Financial crisis meltdown.
yeah,
Everybody.
maybe the entire meltdown of our financial system was occurring during that month. So look at this. This is really powerful. How many clients do you think, how many investors do you think pulled their money out of the market during October of 2008? Probably a lot. Probably a lot. And what we're showing is if you just missed these 2 days in October of 2008, you'd be down 13 grand from where you could have been if you had stayed invested. Now, the reality is, if you're an investor, you likely got out during the entire month of 2008, and you probably stayed out for the rest of the year, if we're honest. Right? Meaning you didn't just miss these 2 days, you missed a lot more days. And what we're showing you is if you had been invested all 25 years and just missed those 2 days, you would be down 13 grand from where you could have been. Now, what about the third best day? You'd be down even more. What was the third best day? April 9th, 2025. When was that? Oh, just a few days after Liberation Day. So what we're showing you here is the impact of if you miss the 3 best days, the 5 best days, the 10 best days, so on, you can just see it just keeps dropping in 25 years. What is the message, folks? What is the message? The message is this: we cannot afford to miss even one day in the market. We just can't afford it. You think that it's not going to matter, but missing one day matters way more than you think it does. And so the way that we win the game of investing is not by timing the market. It's by time in the market. That's how we win the game of investing. And hopefully this gives you some data to maybe make you think twice before you decide to sell and go to cash next time, because we are going to get more volatility this year. I promise you that. So let this be a lighthouse in the storm that keeps you invested even when everything is screaming at you saying, we got to get out, we got to get out, we got to get out. No, actually stay invested. Now, I want to briefly touch on the Magnificent Seven. And if you're not familiar with the Magnificent Seven, these are the 7 largest stocks in the United States. They're actually the 7 largest stocks in the world. They are Microsoft, Nvidia, Apple, Amazon, Meta, Google, and Tesla. These are the 7 largest companies in the world. And they have been the darlings of Wall Street over the last few years. And so we've seen a lot of investors just flock into the Mag 7, just buying Mag 7 stocks over and over and over again, just saying, I don't need any other stock in my portfolio. Well, I want to show you something. Over on the top left, we are seeing last year in July, the Magnificent Seven were 31% of the overall market, and today they're 32% of the overall market. So not much change over the last 12 months. But take a look at this. If I look at the growth stocks in the market, so just the growth stocks, the Magnificent Seven were 55% of the growth index a year ago, and they are 45% of the growth index today. So they've actually come down amongst the growth stocks. And what do we see of the value stocks in the index? Well, a year ago, the Magnificent Seven were 0% of the value index, and today they are 18% of the value index. What does that mean? That means some of the Mag 7 stocks have become value stocks. What does that mean? This means that the market is putting a lower growth rate assumption on some of the Magnificent Seven stocks. And which stocks in particular? Microsoft, Apple, and Amazon. Why is this important? There are 2 reasons why this is important. Number 1, what this is showing us is that the market thinks there are some companies that are winning the AI race and some companies that are not winning the AI race. And I don't know if any of y'all out there have tried to use Siri for anything, but she's not very good. I don't know if y'all have tried to use Microsoft Copilot for anything. It's not very good. So what the market is showing us here is some of these companies are well positioned. Google's Gemini, incredible. Silas and I live in Austin. And I don't know, Silas, if you've ever taken a Waymo at all yet, but they are.
See him driving around all the time.
Yeah, they are. I've taken them many times, and they are awesome. Really, really cool. Waymo is a Google product. So here you have AI literally driving cars around the city of Austin. It's pretty. The first time that I did it, I was with my sister, and we took a Waymo across town. I mean, this thing went on the highway, revved up to 70 miles an hour, and we're sitting in the back seat, and there is no driver in the. I mean, it was nuts. It was totally nuts. I couldn't believe it.
Now, Roman, I haven't brought myself to do that yet. Is there anything that keeps you from like going and grabbing the wheel? How do they keep you out of the driver's seat?
No, it's just right. It's just a wheel. It's pretty nuts.
Does it
But
talk to you or say like welcome or your ride's almost over? Or is there any
so,
type
like
of
when you get in the car, you book it on Uber, and then you get to the door, and then you have to kind of hit a button on your phone, and then it unlocks the door, and then you get in, and then you get buckled up, and there's a little screen, and it says "Start your ride," and you just start your ride, and then it and then it goes. It's pretty amazing. So, look, that's a Google product, Waymo. So, you know, Google is at Tesla has just come out with the robo taxis, which is basically their version of Waymo. So some of these companies are absolutely winning the AI race. They're in it. They're creating cutting edge products, and Apple's still stuck on Siri. So I think what this means is, what does this mean for you as an investor? Let's bring it back to investment principles. Well, we've seen so many clients obsessed with Mag 7 stocks, and they own Apple and Amazon and all these things. Well, what this is showing us is having all of your money in these 7 stocks is, I think, a really dangerous place to be. And the reason why I say that is because let's think back to the early 2000s when the internet was coming out. Who were the darlings of the technology sector? IBM, Intel, Dell, Toshiba, Hewlett Packard, right? The list goes on and on. All of those companies were well positioned to take advantage of the internet boom. Google was a startup in a garage at that time. And look who dominated the landscape of the internet world over the next 25 years, right? It was YouTube, it was Google, it was Salesforce.com, it was Amazon.com, which was an online bookseller in 1999. So the likelihood that these 7 stocks are going to be the darlings of the AI race, we're already seeing some of them cool off a bit. And I think if you have put all of your chips into the Mag 7 names, I think you're precariously exposed, because I think they are all priced for perfection right now. And if there's even one new entrant into the space that disrupts this, you're going to see a massive recalibration among these names. And I think that could mean some significant downside potential for that portfolio. I mean, look at Apple. Apple year to date is down 17%. So I think it's time to think about diversifying your portfolio and broadening out that diversification if you've been heavy in the Mag 7 over the last couple of years. Now, this is a really, really powerful, layering in this idea for diversification, this idea to broaden out your exposure. Here is international stocks relative to US stocks in terms of who's more expensive and who's cheaper. And anytime this blue line is above the gray bar, is showing you that international stocks are more expensive. And anytime it's below, is showing you that international stocks are cheaper than the US. And this is over the last 15 years. Well, what do we see? International stocks have just gone from cheap to cheaper to even cheaper relative to the US. And right now, international stocks are trading have over the last 15 years have traded at an average discount of, call it 17% to the US. And right now they're trading at a 32% discount to the US, a 15-year low. Take a look at emerging market stocks. Historically traded at call it a 30% discount to US. Right now trading at a 42% discount to the US. Do you think we might want to own some international and emerging market stocks in our portfolio? Absolutely. Especially since US is trading at all-time highs over the last 15 years. And we're seeing, like we just said in the previous chart, some of the Mag 7 cooling off in growth rate. And then we've got international and emerging markets trading at 15-year lows relative to the US. This is classic.
You take that into consideration, what we saw in the returns year to date earlier, that you're still seeing those higher returns, but they're still at a discount in comparison.
Absolutely. I mean, you look here at non-US, you can see the little spike over the last year, and this is the 12-month rally. You're still at 15-year lows, even with the 12-month rally. So, yeah, you're absolutely right, Silas. I mean, we're starting to see this trend reverse. I think this trend potentially has a lot more room to run rather than just a little bit of a fluke trade. But we'll see how it plays out. I think ultimately what this means is for all you investors out there, it's probably a great idea to have some international exposure in your portfolio. And if you're too heavy in one area, too heavy in the Mag 7, that's a great opportunity to just get a portfolio evaluation from Silas and their team because they do a great job of that. Now, I want to briefly touch on bonds for a second. I know bonds are sort of boring and I get it, but there's something very powerful going on in the bond world right now. So here is the 10-year Treasury yield. This is going back over the last 25 years. And we are right now sitting here at about 4.5% yield. Last time the 10-year was at 4.5% yield was during 0708. Hopefully that's not a foreshadowing of anything. But here we are at a 4.5%, 5% yields right now. And what we're seeing on the right-hand side is the relationship between the 10-year Treasury yield and what does the forward 10-year return from a bond portfolio deliver when we hit current yields. So let's say we're at a 4.5%, 5% yield, which is where we are right now. This data set is telling me that if I have a 4.5%, 5% yield on the 10-year Treasury note, that means my bond portfolio is going to deliver over the next 10 years about a 4.5%, 5% rate of return. It's pretty astonishing that we almost have a one-to-one correlation between the 10-year Treasury yield and the next 10 years of bond returns. What does this mean? Well, how many of these investors do we come across that are sitting on CDs right now? They've got their money in a CD because the CD is clipping 4.5%, 5%, FDIC insured, right? Risk-free. And they think, oh, this is the best place ever. Well, what we're saying here is the time to buy into a bond portfolio is not after the Fed cuts rates. The time to buy into a bond portfolio is before the Fed cuts rates. And right now, as we've been saying, the economic information is improving. We think there's probably going to be some Fed cuts sooner rather than later. And so if you've got a maturing CD, what we would say is probably buying a bond-heavy portfolio makes a ton of sense with that maturing CD because that's going to allow you to capture forward 10-year returns from these bonds, whereas your cash CD is just going to start dropping and dropping and dropping as interest rates get cut. Something to think about.
So to emphasize that, if you're in that place and it feels good and feels safe to be in the CD, right, and you're holding on to it towards maturity and you're seeing the bond market goes up, right, that's the inverse nature of people's reaction. They're going to continually possibly see interest rates going down. So any CD renewals that are a lower rate than you were before while watching the bond market continue to show higher yields. This is a great emphasis to make sure that you're not caught in that position.
Absolutely. Absolutely. And if you're sitting on maturing CDs, I would say grab a call with Silas and just see what alternatives they might have to that maturing CD, because there's a lot of great things that we can do with excess liquidity and your managed reserves of your financial plan. There's a lot of great things we can do with that.
And I would ask also on the taxation of that. Remember that the interest on CDs is taxable as income. There are things that we can do in bond portfolios to use tax exempt bonds to help offset or eliminate a lot of that taxation, therefore even increasing the net yield that you can receive. So it's something very much to dive into, and we welcome those discussions for those.
Absolutely. Nobody talks about the taxation of CDs, right? And if your tax bill was higher than you thought, I bet you a big part of that was because you're sitting in taxable CDs. And there's a lot better places that we can put that money. Let's do a quick review of tariff timelines as we sort of land the plane here. We get this a lot from clients, which is I should have put my money to work right after Liberation Day, which is the comment that I made earlier at the beginning of this call, which is, hey, we got that drop during Liberation Day. Did you put your money to work? All you market timers out there. Well, what if you had put $100 into the market before Liberation Day? Some might argue the worst time to put money into the market. Well, let's say we put $100 in right before Liberation Day. Then here's your Liberation Day drop. Then you get the 90-day pause. Then we sort of drift sideways for a bit. Then we get the exemption on autos and so on and so forth. The market keeps going up and up and up and up and up. And if you had just stayed invested and ignored the noise and ignored the media, you'd be up 11% on your money if you had invested before Liberation Day, literally the day before Liberation Day. I bet you many clients don't know that. You'd be up 11%. That's double what you're making in a CD right now. If you had invested before Liberation Day and hung on through the ride, again, solidifying this idea that we need to stay invested during times of turmoil. We don't want to have these knee-jerk reactions that pull us out of the market because of news or headlines. So I think this is a powerful timeline to have in your head because we're going to get more tariff headlines on the future and probably more volatility in the future. And I think that having this sort of as a guidepost is really powerful to just make sure that you stay invested and ignore that noise. Now, I think this could be a great place for us to maybe land the plane here because whenever the market does go negative, it's not necessarily the end of the world. There are opportunities when the market turns negative. And what we're going to show here is two lines. The orange line is showing us the US stock market, and the blue line is showing us the international stock market. And what it's showing us is the percentage of the market that traded negatively during the year. In other words, what percentage of stocks in each market had a negative return year to date? So let's go to January of this year, really over the last 6 months. Okay, so in January, about 40% of the US market was trading negatively year to date. And then as we move towards Liberation Day, what do we see? We see that goes higher and higher and higher. And then here's Liberation Day, and you're talking almost 90% of the stocks in the US market were trading negatively. And then as we come out of Liberation Day, where we see that drift back down to about 50. Now, the market is up 5.7% year to date. So your market's positive 5%. But look at how much of the market gave you an opportunity to harvest a tax asset. And for all of those who are unfamiliar with the concept of tax loss harvesting, this is the idea of strategically selling stocks when they dip into negative territory to capture a tax credit that we can use to offset future capital gains in our portfolio. And many portfolios out there don't take advantage of this phenomenon. As we can see, the market is up 5.7%, but there was so much of the market that gave us the opportunity to harvest tax credits. And many portfolios are not taking advantage of this opportunity. And so if you're an investor that has taxable money and you're invested in a mutual fund or an ETF or some sort of portfolio, it's worth asking the question, am I invested in a portfolio that is actively trying to pick up tax credits to reduce my tax bill at the end of the year? And if the answer is no, then you might want to chat with Silas and his team because they do utilize portfolios that engage in actively harvesting tax credits as we move throughout the year to make sure that at the end of the year, you still have your nice return, but hopefully you have zero taxes due. And many clients aren't in those types of strategies. And so if that's a strategy that piques your interest, I would say definitely get in touch with Silas and learn more about the tax managed approach. And with that, Silas, that sort of concludes my thoughts. I will hand it back over to you to see if there's any thoughts you want to wrap up on.
Roman, thank you very much for making the time for our listeners and those who watched. This is a great opportunity to go to silasparker.com, schedule a session, upload your statement. If you have the question of whether or not your portfolio is actively taking advantage of those type of tax harvesting opportunities, it's a great time for us to review. There's some analytics that we can run in regards to the portfolio to be able to show you how much more you would be able to net by having these type of strategies put in place for you. So on that note, any other questions that you have, feel free to reach out to us. We're here for you, Roman. Thank you again so much. And on that note, looking forward to our next market update. Make sure everybody subscribes to tune in for the next one.